Welcome back to the Wall Street Breakfast. It is time to get smarter about money. Subscribe for more awesome content, and let's get started. This is how to trade and invest like a pro. You might have heard about the stock market and trading, but have no idea how it all works, or why it's so important to the global economy. Don't worry. Even some of the most successful business people in the world had to learn how to trade and invest like a pro, including Apple co-founder Steve Jobs and Berkshire Hathaway CEO Warren Buffett. You can read their biographies and follow in their footsteps. Here are 10 keys to help you learn how to trade and invest like a pro. Trading is not gambling. Before you even think about buying stocks, bonds, or other investments, it's important that you first understand how trading works. Many people assume that investing is just gambling on stocks, but for most people, trading is an entirely different investment vehicle with completely different strategies than gambling. Understand these strategies before you ever open an account or make your first purchase. Otherwise, you could make some very costly mistakes. You can learn more about trading by reading articles from online sources such as Investopedia and Business Insider, or by taking classes through your local community college. If you don't have access to either of those options, consider asking someone at work who does know what they are doing for tips or guidance. You might be surprised at how many coworkers have a passion for trading. It's not uncommon in our current economy. Professional traders have an edge. Experience. Before you get started, it's important to know how seasoned traders make money, and more importantly, how they lose money. The latter is just as important because getting rich isn't just about making money, it's also about avoiding losses. Investing in stocks, whether for short-term trades or long-term retirement planning, is risky business. Failing to prepare can leave you broke, bitter, and angry. Here are some common mistakes that new investors should avoid at all costs. 1. Taking on too much risk. While there's no one-size-fits-all approach to investing, novice investors typically take on too much risk by trading high-risk securities such as penny stocks. You can be part of the next generation of traders. If you start trading, you will learn many things. You'll learn how to pick stocks or commodities, when to buy and sell, where and how much leverage to use, what order types you should be using, when your broker will take care of that for you, etc. There is quite a bit that goes into it. The list is literally never ending. But as time goes on, you'll also learn more practical aspects of trading, like risk management. This means knowing how much money you can afford to lose at any given point in time. And once you know that, it's easy to figure out just how big a position size you can handle before risking too much capital. Understand what you are investing in. Before you can make an informed decision about what to invest in, you need to understand what your investment is. To take an example, most people, and even financial experts, don't know how derivatives are structured or what they can do. It's important that you have at least a basic understanding of these investments before trading them. The complexity of some investments means that it's best not to jump into them without knowing more. You should also consider seeking professional advice if you are unsure whether a particular investment is right for you. You might find a reliable broker through friends or family who can help advise on which investments would be appropriate for your situation. Be patient. Trading takes time. It's important to be patient while you learn how to trade and invest. There's no overnight success when it comes to trading, so don't expect your initial trades or investment strategy will land you millions overnight. Even after years of experience, there are still days where nothing seems to go right. The key is not giving up when things aren't going well, but that doesn't mean you should keep throwing money at bad trades either. As Warren Buffett says, "I never attempt to make money on the stock market. I buy on weakness and sell on strength." You need to do exactly what he says. Find stocks that have dropped in value, aka become weak, but still have good potential for growth, aka strength. In other words, look for stocks that are undervalued in some way. Set a realistic goal and schedule. It can be tempting to try to turn your 10-bagger into a 100-bagger overnight. That's rarely how it works out, however, so don't set unrealistic expectations for yourself. Have realistic expectations about how much you can make in one day, week or month, and then put together an action plan with specific objectives. If you focus on realistic goals, they're much more likely to be achieved than if you have lofty expectations that never pan out. After all, investing is no different from any other skill. You must practice it consistently to improve over time. You wouldn't expect to become a great tennis player without hitting balls or golfing champion without playing lots of rounds. The same goes for investing. In fact, just 15 minutes per day studying investment books, like Benjamin Graham's The Intelligent Investor, and writing down notes will help hone your skills faster than anything else you could do instead. Setting stops will help avoid losing all your investment capital. Set stop-loss limits for every investment, when you buy or sell. This will ensure that you won't lose all your capital, even if things go really wrong with one particular security. If things go really well with it, you can see what's going on by monitoring its performance daily. Stop losses are used in all forms of trading, not just forex trading. You can set a stop loss at either a percentage, for example, 5%, or dollar amount, for example $1,000, away from your entry price. It is very important to set stops correctly because once they are hit, you may be forced to exit your position at an unfavorable price point. Taking trades at the right time gives you an advantage over other amateur traders. It means you make more money. For example, day traders take trades during market hours, when volumes are high. This ensures there's enough liquidity to facilitate transactions without driving up prices too quickly. Day trading also allows you to make small profits repeatedly throughout each day, while limiting your risk exposure by making big bets only when an asset is surging. If you're interested in learning how to trade and invest like a pro, here are some things to consider. What kind of trader are you? There are two main types of traders: technical analysts and fundamental analysts. Technical analysts focus on charting trends to determine where price action will go next, while fundamental analysts rely on economic factors such as company earnings reports or Federal Reserve announcements to inform their decisions. Learn how to read charts. The basic principle behind technical analysis is that historical market data can predict price changes in securities. The key word there is historical, which means reading charts is about studying market history, not making predictions for future price movements. Whether you're new to investing or have been trading for years, learning how to read charts will take you from being a novice investor, trader to becoming an expert. Here are some of our favorite resources: Investopedia Stock Charts course, Investopedia Technical Analysis course, Investopedia Options Trading course. Have realistic expectations. When you're just starting out, it can be difficult to judge how your investments are performing. Sometimes things look really bad, but then, on average, they get better. The hardest part is keeping things in perspective. It's important to keep realistic expectations so that when your investment does well, you have something good to celebrate, and when it does poorly, you don't lose sight of why you're investing in first place. For example, if you invested $100 into a stock and it went up 10%, you might think that was great, but if you invested $1,000 into another stock and it went down 50%, chances are pretty good that your stomach would be turning more than your portfolio. In other words, don't let small fluctuations fool you into thinking or feeling one way or another about your overall strategy. If you made it until here, thank you for watching. Please support the channel and subscribe.